Okay, so everybody, thank you for being on today. We are the Equi team. Okay, it is me, it is Itai, it is Tori, it is Rommel, it is a whole cast of incredible talents on our team, and we're basically the first digital family office. So we are the one-stop shop way to get a diversified and managed portfolio of the best alternative investments. Why is that important? Because you're going to learn about things like inflation today, and you're going to ask yourself, Itai, Jeremy, what do I do to fight inflation? And we're going to basically just say, well, Equi, of course. No, there's actually a lot of different things that you can do. But at any time, we know a lot of you have been following us. If you know that you're on board and you're looking to invest with us, we actually are kind of running out of some of our seats really quickly. So I'm going to drop in the chat a link where you can fill out at any time and get going. But in the meantime, what I want to do is I want to introduce Itai really quick. And after we do that, Itai will be able to walk you through everything that you're going to learn today. So Itai is our CIO. He is my co-founder here in this venture. He's an incredibly talented guy. Itai worked ultra high net worth at UBS. He has started a wealth management practice that had over $100 million in it. He ran a hedge fund that was uncorrelated to the markets. Itai, is there anything you can't do in finance and investing?
I don't know. I just try to make money from money. That's a fairly simple skill, right?
Yeah. So let me ask you this: if tomorrow you could become the chairman of the Federal Reserve and give up your role at Equi, would you do it?
Probably not. You know, he has too many perverse incentives, I think. And I think that the reality is I'm just joking, but nobody can predict the future. And as a result, I think the only way to truly create consistency in returns is just diversify across as many things as you humanly can.
There we go. Wise words from a wise man. So Itai, you're the star of this show, and I'm just here to kind of interpret some of the things, ask some questions, and we want everybody to ask questions as well. Do you want to take this and tell everybody what they're going to learn about today?
Yeah, for sure. So I know inflation has been a hot topic. Just wanted to dive into what's happening right now, a little bit about what inflation actually means, because I think there's a lot of misconception about what inflation actually is. So we'll go a little bit into that. And more or less what that means as a general thing for, for the portfolio, or potentially where things could go. And I will say I've missed having the market call. I know it's been about a month, and this is something that I personally enjoy doing. So feel free to bring in questions, and this is supposed to be interactive, and that's what makes it fun.
Cool. All right, well, hit us with the things that we need to know.
All right, with that said, can everybody see the screen?
Yeah, I can see it just fine. Are you inviting Equi University? Is this what it's called?
Equi University. So we are, as Jeremy said, turn yourself into a family office in an easy way, diversify into alternatives. So let's just dive right into it. So inflation has been on everyone's mind. If you're looking here at Google Trends for inflation, it's been the highest in over a decade. Everybody's searching it and trying to find out, well, what is inflation and what kind of inflation we're seeing. So that shouldn't be a surprise given CPI readings that came in last week. And CPI is, in fact, in some ways of measuring it, the highest it's been since the 1990s. So that's pretty significant and potentially on everyone's minds. So what's driving this large move in CPI? The biggest change in CPI has actually been the used car market. After seeing an initial drop in 2020, used car prices have gone fairly exponential. And for anybody that's interested to see what's in the CPI basket and what percentage of CPI is currently there and how the changes went, that's how it looks like. So if you see here, used cars and trucks, as Jeremy mentioned at the beginning, the 1 month change in May was 7.3% and up 10% in April as well. So a total of 17% increase in just 2 months. Food prices going up slowly, everything else more or less going on slowly. Used car sales, definitely a big increase, and shouldn't be much of a surprise, but airlines as well, up 7% and up 10% the prior month. So it's not just in the US. I think it's always important to keep track of what's going on in China. And China has also had a very hot PPI. So this is the supply side, right? Basically the producers and their commodity input prices and things like that. And they're seeing the highest PPI reading since Lehman, which typically leads CPI going forward. So they've already implemented some sort of price controls over some of their more important commodities because they're worried about CPI essentially going in too hot. So that's something to definitely note. So the big question is, I apologize, is shelter inflation coming up. So what's shelter inflation? Think of it as the price of the rent you're paying for a house. And here is the year-over-year asking rent in various cities. So it's been a pretty significant barbell with very large rent decreases in places like San Jose and San Francisco, and very large increases in places like Atlanta and Phoenix, where people have been moving into. And the question that we should ask is, are we going to see some kind of mean reversion, or are we going to see a significant increase in rents potentially across the board? So we have to realize the Fed is still buying large amounts of mortgage-backed securities. And that means that there is still pressure for interest rates and mortgages to be relatively low. That's enabled home buyers to step it up and pay potentially more than they would have otherwise to get the same house. So as a result, amongst other factors, we've seen inventory in the housing market reaching all-time lows. So I don't know if anybody has been buying a house lately, but I've heard a lot of horror stories over multiple offer situation, very difficult to buy a home, especially where we are in Austin. It's been unbelievable.
It's been nuts. Are there, I know in your last slide, Itai, you talk about how the Fed is still monetizing. Are there any plans to taper those QE programs?
Not right now. So we potentially are going to get some taper talk in the Fed meeting, but so far there has been no indication, and there's still a lot of money going on, and the bid is still being hit consistently, which arguably is fueling more inflation to a market that's already relatively heating up. So that remains to be seen. So as far as the housing market goes, again, so very low inventory, very difficult to buy a home, and this is starting to discourage people. So when you're looking at the sentiment condition for buying a home, so people are asked the question, do you believe now is a good time to buy a home? Yes or no? And that has basically fallen off a cliff to an all-time low, with a lot of people being discouraged by the housing market for a lot of reasons. And some of them are now affordability. Prices have just gone up so much. So in theory, when you see something like this, it tells you that some people, or a lot of people that were potentially going to buy a home, are now saying, well, I'm probably going to hold off on that purchase, or I'm going to rent for a longer period of time, or maybe now it's a time for rent. So when you're looking at the prices of homes and inventory versus the rent inflation, which hasn't been as much, especially in some cities, it's very possible that you will see a significant increases in rents coming up, given these numbers. So this is something that could obviously happen.
Do you think?
What is SD? What is SD, Itai?
Just a standard deviation.
Oh.
So this is your mean. This is where it normally goes, and that's essentially a 6 standard deviation move in that sort.
Wow.
So quick question. I literally saw a tweet today saying that going in cap rates in Austin, Salt Lake City, and if I want to say Phoenix as well, were coming in at 3.5%. I'm guessing these are for some A-class type of buildings, maybe even some Bs. Do you think that the cap rates are reflecting some of that expected inflation?
Yeah, I mean, you're probably seeing some of the money going in, expecting some kind of rent increases going forward for them to be buying at those cap rates. So they're probably saying, or the cap rates may be pricing in some kind of future rent inflation.
Cool. We better buy our assets ASAP.
Exactly. So this is until, of course, inventory keeps up. So after COVID, everybody wants to live in a single family home. That's been a very common shift, and some move to some of the smaller secondary and tertiary cities that we've seen across the board. So on one hand, you have your home builder sentiment, very, very bullish. All the developers, they can't wait to build new subdivisions all around. And at the same time, home buyers sentiment have collapsed. They're very discouraged by the housing market. So that's a fairly big divergence. We haven't seen something like this before. So it's interesting to see how that's going to play out and what the implication on rent inflation is going to be. Because we have to realize shelter, I think now it's a little bit lower than when this came out, maybe around 32 to 35%. But nonetheless, housing and shelter is a very significant portion of the CPI calculation. So if you're
if you could back it up a sec, could you go to that last slide? How is it possible for there to be such a large divergence if historically these two have kind of moved hand in hand?
Yeah, I mean, that's a good question. I think on one hand, prices have gone up and demand is so strong that home builders are feeling very encouraged by the market because every time they're building something, it gets snapped up in 2 seconds. But on the other hand, the lack of inventory and this fierce competition in the buying market is just making home buyers very discouraged. So I don't think that situation can last indefinitely. And you know, one of the things is probably going to give in the future, and you're going to see this mean revert. So again, with people potentially discouraged from the housing market, if they go in and rent instead, that could impact housing as a portion of CPI. So far we've seen, you know, the used car market or maybe airlines, but if we see shelter inflation in a big way, that would have a very, very significant impact on CPI. And this is happening when, you know, the real wages, quote unquote. So when we know there was wage inflation, we know basically people are getting paid more, $15, $18, $20 an hour now in many instances. And if you look at that, given the CPI, the real wages have not kept up with the increases in prices. And this is despite the fact that you're seeing a pretty significant disruption in the labor market. So what do I mean by that? Here in red, the red line, you're seeing the total amount of job openings right there. And here in blue, this is the amount of unemployed people. And here is the spread between them. So if every single unemployed person in the country would go and fill every open position right now, you effectively would zero out unemployment completely. So what I mean by that is there are just enough open jobs out there as there are unemployed people. And
Itai, do you think we could pause for a second, just because I saw a few comments
Sure.
in the chat, and I just want to make sure we're all getting to it. So do you know if the homebuyer sentiment includes foreign homebuyers?
I don't think it does.
Okay, got it. And then one of the other comments was, you know, maybe the demand was strong due to lockdown and shortage of inventory plus labor during the COVID period.
Sure.
Do you think that that's possible?
Yeah, so there are commodity increases. Lumber has gone up quite a bit. Now it's come down from the top, and we're seeing a lot of reopening. So there was definitely, like we call a base case effect at the beginning, but now with things opening up more, it doesn't appear like the housing market has cooled off so far, and inventory supply is still very, very tight. So it remains to be seen in the next few months, you know, what you're going to see with that. But you know, it seems like as prices continue to rise, it's just essentially pricing more and more people out of the market right now. So eventually it will have to level off. At least that's my opinion.
And just for everybody else in the audience, I know we're going a little fast. Are there any other questions that are on your mind before we go to the next slides?
Yeah, it's David. I'll chime in with one. Is there a possibility that rents increase enough that there's actually people that just can't find a place within their budget? That'd be question one. And then two, if it becomes too large a portion of somebody's budget, does it hurt the rest of the economy because now they don't have discretionary income?
Yeah, that's fairly common. Apologize for the dog, by the way. But I mean, you could see this is exactly what could happen. So it hurts discretionary income and eventually cools off the whole economy, and then the whole thing cools off. But I think with remote work is also something you have to consider here that is fairly new. in a way that if somebody gets priced out of a certain area, they now have the ability to potentially move to another area and keep their job, given the dynamics of the economy. So there's a lot of things here that could potentially happen that we don't necessarily know how that's going to play out. Awesome. Thank you for all the good questions, by the way. This is how we like doing it. So I'll continue. So effectively, real wages haven't necessarily kept up. And again, we're seeing a fairly big disruption in the labor market where we have a lot of unemployed people, and job openings have now reached a record high, and businesses are complaining that they're having a very difficult time filling jobs, wages are going up, etc. At the same time, keep in mind that a lot of states are starting to drop the extra unemployment benefits fairly soon. So it remains to be seen what that does to wage inflation and those labor shortages. I think it will be interesting to watch the labor data from the next few months to see how that plays out. But within a few months, essentially all states would probably drop this, assuming data improves.
And if they drop it, how do you think that the amount of the total number of unemployed openings will be affected?
Yeah, so they will probably drop. I mean, once the unemployment benefit drops, then it will probably force people to go back into the labor force and take some of those open jobs.
Cool, thank you.
So I think what's really interesting to note is that the bond market right now, and this is one of the bigger mysteries today, is the bond market is not pricing in that higher level of CPI data at all so far. So you can see the correlation here in blue between the CPI data, which is a year-over-year data, and the correlation to the 10-year treasury. Typically, with a higher level of inflation, you would see a higher level of CPI data. But we just had our 5% CPI read, but the 10-year treasury is just trading at 1.6%. And we've seen a pretty big divergence between the two. And it's important to understand how bonds work to see why that is very significant potentially if these things will revert. So Jeremy, you want to tell everybody how the bond market works?
Yeah, so I just don't want to assume that everybody knows. So let's just do an example. We'll do a high interest rate example, factoring in me and Itai. So Itai, basically, I give you $1,000 and you promise to pay me $10 a month for a year. So I'm going to make a 12% interest rate, and then on that money, and then at the end of the year period, I'm going to get my $1,000 back. Okay. Well, we have to talk about what's the relationship between interest rate and bonds. So let's say the prevailing market economy is pricing in an interest rate of 6%. That would cause my bond prices to rise. Why? Because there's going to still be that $10 payment that's coming through each month if I own the bond. But if the market's pricing in a 6% return, the bond price would have to go up to $1,060 to basically create a 6% return on those cash flows of 10, 10, 10 each month, and getting the 1,000 back. So as the interest rates decline, the bond prices go up, and vice versa.
Yeah, that's a really good description. So effectively, the one thing is, the longer the maturity of a bond, the more it's going to be impacted by those interest rates, right? So if you have 30 years left on your time horizon, then potentially the implication is going to be significant because you have to make up for 30 years worth of interest, right? So that's why these longer term bonds have a much greater sensitivity to interest rate changes than short term bonds.
Which brings up a great question, which is who is in the market to buy a 30-year bond in the type of environment that we're in right now?
The Federal Reserve, for one.
Okay, fair. Outside of the Federal Reserve.
So we have seen a lot of those buyers dry up, but you still have different banks, pension funds, and other people with various mandates, or institutions primarily. It wouldn't be private individuals, but you even have foreign buyers such as Japanese banks and pension funds that they have a negative interest rate environment, and they may engage in some of that.
Great.
So I think this is a really important chart to understand. you can see the relationship between CPI. So CPI is here at the bottom. You see from 0 to 6% on the x-axis. And then on the y-axis, you get the US 10-year Treasury yield. So typically, historically, they've been fairly correlated where higher CPI translate to higher yields. And you can see that May 2021 read is an incredible outlier. In fact, this is the greatest outlier since these measurements are measured here in 1991, and I think it's actually the greatest outlier since 1980. So historically speaking, rates have almost never been that low given CPI or inflationary readings that are that high. To illustrate the point, this is another way to look at things starting here in 1952. And this is the difference between the CPI reading and the 10-year Treasury yield. So it's 5% and minus the 10-year Treasury, which is roughly 1.5%. So that means that if you buy the 10-year Treasury, you're effectively making a negative 3.5% adjusting for inflation. And we've seen periods of negative real yields before, mainly in the early 80s and in the 1970s, but those don't last too long. So if history is any guide, it's very likely that you're going to see down. You're going to see either the 10-year Treasury yields come up, or you're going to see some kind of mixture of the two. So I was thinking about what are the reasons effectively for this kind of bond divergence? Like why are you seeing such low yields compared to such high CPI readings? And I think there are a few explanations we can think about. So the first one is what the Fed says the bond market is buying. So Fed says this is transitory. In a few months to a year, inflation is going to go back down to that 2% normal. So the bonds are already pricing that in. They're saying nothing to get excited about over a transitory event, and therefore we're not going to go up. At the same time, there are negative bond yields around the world. So we have to remember we live in a globalized world where there's external demand for the US dollar. We can revert back. We did a pretty long series on the petrodollar and the implication on the world. So there is external demand for dollars as the global reserve currency. And those foreigners typically hold those dollars in US treasuries. So there is an external demand for that, which could artificially make the yield a little bit lower. And of course, the Fed and commercial banks bought $4.4 trillion of treasuries in the past year, and that is still going on, right? This has not been tapered so far. There's still a significant bid, which, as you continue to buy bonds, that effectively suppresses yield because they have a negative correlation between bond yields and price. And obviously, the last potential is that the bond market is wrong, and we will get a repricing of the bond yields, and that has significant implications into absolutely everything. So I'll stop it right there and see if anybody wants to ask any questions about that. That was a pretty complex topic.
Also, real quick, Itai, if you could try maybe turning on and off your video. It's frozen for a bunch of us, so I think if you turn it off and turn it on, sometimes that unfreezes it.
Oh, sure.
And it's not a big deal too if it's not working. The more important thing is that you're able to share your screen and that you're giving good content. So that's the most important thing.
Did that work at all?
It did not. So why don't you just continue on as normal? We all know that Itai is actually there. He is not just an invisible voice that is whispering things about the Fed in our ears.
Sounds good.
But any other questions before we continue? Silence. Okay, continue on.
Sounds good. Hold on.
I see some boxes popping up on the screen, Itai. Is everything okay?
Yeah, the Zoom is just delayed.
Okay.
So let me ask you a question, Itai. Just going over all these charts. is when in past in history have we, kind of experienced the same type of scenario, and what happened during the next like 5 or 10 years or even year? Or even or in another country that this has happened, it's an industrialized country.
I think your question must have scared Itai, because he literally missed the whole thing, and now he's signing back on. So you're gonna get to ask it again.
Okay.
Okay, hold on 1 second.
It was that new Microsoft Office subscription of his that did this.
Yeah, right. We gotta get off that. We gotta stick with Zoom products. Okay, Itai, I think you figured it out. Rob.
So it's 2021, and there are always some kind of issues sometimes with Zoom meetings. So I apologize.
Real quick question, Itai. So showing obviously we've got inflation, we've got low interest rates. I'm sure you went through this in chart, maybe I just missed it, but in the past, either here or in an industrialized nation, what's typically happens on these? Obviously, like you said, interest rates will rise, inflation will come into check. What happens to the overall economy on those, like stock market, that type of stuff, recessions, that type of thing, when we run into these type of situations?
Yeah, so that really depends on how interest rates go up. Historically, if interest rates go up in a mild fashion over a long period of time, that typically is bullish for the overall economy and stock markets. If interest rates get repriced violently and it feels like the Fed is losing control, then that potentially could be very negative for markets. So it really depends on how that kind of plays out.
Itai, one of the questions came in from Rodrigo. Rodrigo, do you want to ask that question? I thought it was a good one.
Sure thing. Thanks. So the question is, are tips a sensible investment during this time with this situation going on?
Yeah, potentially. Treasury inflation protected securities. So also, if you ever looked, tips are very correlated with the price of gold, which historically also have done well in inflation. So yeah, tips typically respond well to inflation.
Thanks.
Sure.
Itai, can you think of any case on behalf of buying bonds in general in this environment?
Yes. Don't fight the Fed.
Okay.
But I will say though that the upside versus downside, given where bonds are, it's buying a long-term bond is potentially a fairly risky trade. So again, here's that bid. You're asking the pro bond case. This is that $4.5 trillion that was purchased in about a year. So the Fed's balance sheet is up here. That's actually the total. The Fed is here. It's important to note that commercial banks also are holding $4 trillion worth of treasury securities. And we've spoken in a call before over the glut of liquidity that banks are sitting on, and they literally can't even lend as much because they're getting so much from all this quantitative easing. And at the end of the day, they have to buy some sort of treasuries as well, because they have to keep collateral, to keep reserve ratios and different types of requirements that they have. So they're also a sort of bid to treasuries. So again, the $64 trillion question, is the Fed going to taper? I think that's a really good one. And we should listen to the next meeting and see what the Fed is going to say. Here again, that's actually the tips expected inflation rate, to answer your question, versus the CPI. So CPI reading obviously fairly high. The question remains, will tips continue to increase in that, or again, is it transitory and therefore tips may even fall in price? And I think that's also one of the things I look at to kind of compare and see where inflation is at the moment.
And when's that next meeting again?
I think it's this month.
Okay, I feel like Gary would know this for sure.
Yeah, it's fairly soon.
Okay.
So important to note, okay, this is something that we should disclose. Inflation forecasts tend to be wrong historically. So here is Europe, where Europe is considered a boring place to predict inflation because it hasn't had a lot of inflation. It's just stable, low inflationary environment for a very long period of time. And you can see here the predictions of the ECB themselves, IMF, OECD, different factors where they're sitting. and the average mistake. So take a year, not even COVID, take a year like 2019, where they're sitting on a 60 basis point mistake in a year of 1% inflation. So that's what, a 50-60% mistake in predicting inflation. So that's something to note. Also, the markets are not doing the best job at predicting inflation either. So you're looking at the Fed funds futures versus the Fed funds themselves. You know, for example, here after the 08-09 crisis, Fed funds futures believed rates would go much higher, much sooner than the Fed ever had rates going. And even then they thought when liftoff started that it would be more aggressive, and then they thought it would stay flat. And obviously COVID happened, nobody predicted that. And this is a fairly common theme. So that actually tells us that the interest rate market doesn't do the best job at pricing inflationary moves. So also for the various derivative traders out there, that means that certain options and futures on these types of markets aren't necessarily pricing things correctly if inflation were to come in or not. So this is just something to think about.
That was a good insight. Let's make some money.
And so why is that, right? Why is that? And I think one of the things we have to realize, inflation is extremely complicated, right? And it's difficult to predict. It's driven by multiple factors. So what is the classic definition? The classic definition is continuous rise in general price level, usually attributed to increase in volume of money, credibility, goods and services, blah, blah, blah. What does it really mean? It just means there's a rise in prices of everything and there's more money out there. But I wish it was that simple, because there is not a single theory of how inflation works that people actually believe on a mass scale. There's no like specific, oh, this is the theory of inflation, this is how it works. So what is the inflation? The CPI, the PPI, the headline, the core, goods, services. And I think there are generally three types of inflation, and we're going to dive into what each one of them is and what they mean, right? So first of all, we have the monetary inflation. So monetary inflation is, we look at the broad money supply, the M2, or we call it MZM. So this type of inflation is not, prices are going up and, that's inflation. It's simply the amount of money in the financial system is going up, not prices, but there's just more money out there. That's it. And M2 is all the different bank accounts for businesses, people, companies, all the checking and saving account and all the physical money in circulation. That's M2. That number goes up, we're having monetary inflation. As simple as that. And this is a look of what that monetary inflation looks like starting in the 1960s. So in blue, you see the total amount of M2 broad money in circulation. And then in red, that's the year-over-year rate of change. So for example, between the last year and today, we've seen a 27% increase in just the total amount of money in circulation, checking account, deposits, etc. So we've definitely seen a lot of monetary inflation.
Got it. So quick question is then, let's talk about like the mid 80s to mid 90s. Actually, it looks like they slowly taper off. Why did that happen?
Yeah, so I mean, a lot of things were happening at that time. There was a lot of automation. There was a tech boom. The economy was very hot, and actually velocity of money, so how many times currency in circulation changes hands, was going up exponentially. So it's very possible that the Fed reacted to that by not expanding the money supply as much, or banks were not lending as much, which we'll see it's also a factor in that. And that kind of reins that in. So if you had even more money in circulation, you may have potentially had an even greater asset bubble, which actually, you see, there was a recession in 1991, but eventually there was more money going into the system into 2000. But that's interesting to know for sure.
Cool. And do we have any questions from anybody in the audience before we keep going on?
So again, what are the drivers of that monetary inflation? Just like we talked about, banks can make more loans. It's simple as that, which also in a way it's a derivative of the Fed, because the Fed sets up the required reserve ratio, which is how much money can banks lend out versus keep in deposits. So creating more loans typically increases the deposits as well, because you have more money multiple. Another thing that has happened right now is that the government is going to run a huge deficit. And as a result, the central bank is going to monetize some or all of that deficit. And they're gonna basically buy the new debt the government is forming. And we have seen that monetary inflation could be a precursor for CPI. So that is something that's definitely possible. And we'll dive into that. So what is CPI? The consumer price inflation. So this is something that is important to understand because this is a really important concept for understanding inflation in general. So CPI, or consumer price inflation, it happens when the nominal price, so just the actual price, not the amount of money out there, but the actual price of something goes up, a good or services. So for example, last year you paid $4 for a cup of coffee, and this year it's $5, right? So we effectively seen a 25% year-over-year inflation in the price of coffee. And that doesn't necessarily mean that we've seen monetary inflation, because a specific good or service could have a specific reason why that happened. So let's say there was a drought in Brazil and the price of coffee, the commodity, there was way less supply because of the drought caused a lot of damages to crops, and the price of that specific commodity went up. That's going to potentially increase the prices of coffee globally, and that has nothing to do with effectively with monetary inflation. But it's when you're seeing the prices of everything going up. So we're seeing the price of coffee and tea and cars and used cars and airlines and et cetera, et cetera, et cetera. So the price of almost everything is starting to go up simultaneously. That probably doesn't mean there's one specific problem. It means that the currency itself is losing its value. It's losing its purchasing power. Prices are not actually going up. It's the currency itself that's losing its value. So that's an important concept. So in the past, we've seen a link between commodity inflation and CPI. So commodity inflation in blue versus CPI here in, actually it's the other way around, sorry. So commodity inflation in red versus CPI generally in blue. It's been fairly consistent. If you watched our dollar call, you remember this year very well, 1971, where the gold standard is delinked and all currencies go to fiat, and inflation essentially became much more consistent since. And dive a little bit into that. 1913, the year the Fed was established, basket of goods was $10. Today would cost $265, so about a 26x increase in inflation since. But between 1913 and 1971, we've seen a 4x increase, wherein between 1971 and today, it's already a 6.5 increase. So inflation became much more consistent since 1971, which makes sense because the currency is no longer linked with gold. So what's also interesting to note, and you can see here in CPI, so this is CPI going back to 1900. Between 1900 and 1971, we've in fact seen periods of both inflation and deflation on a kind of like a swing. You get depression, you get basically like inflation, you get deflation. But since the 1970s, it's been very consistently only inflation with very, very short periods of deflation, such as the 08-09 financial crisis, COVID, for example. A short period of deflation caused a multi-trillion-dollar margin call around the world because we have such a debt-based inflation-dependent system, caused the Fed to purchase $360 billion at the days where the markets were crashing just to stabilize it and bring inflation back, because our system is in fact dependent on inflation. So that was the second part, was CPI, and I think we're getting into the more important part, which is the asset price inflation, which is something that's very important to understand. So what is asset price inflation? That's referring to just the value of financial assets, right? So you have stocks, you have bonds, gold, you have even expensive watches, cars, and all those kind of things. And households effectively hold these things, right? So their net worth includes these type of assets. And asset price inflation tend to happen in periods of wealth concentration. So it means a small portion of the population holds the majority of the wealth, and interest rates are fairly low, so they can accumulate more of those. So just think of it this way: if new money is created out of thin air, and it ends up primarily with the top 1%, it's not going to create a lot of CPI inflation, because if a rich person gets access to this new money, they're not going to go and eat 10 dinners and buy 15 used cars. They're probably going to go and buy stocks, bonds, and real estate with it, because they're going to invest the majority of the money that they don't spend. And that's the big difference between asset price inflation and CPI inflation. So we've seen a lot of asset price inflation, and here's the evidence of that. So if you're looking at net worth as a percentage of GDP, so people's total net worth as the total share of the economy, it's almost at 20%, or it's just about at 20%. And when interest rates were higher, that just wasn't the case. So we've seen a lot of increase in the net worth as a part of GDP. And we've seen the wealth being concentrated primarily at the top. So when you're looking here at the top 20%, they hold $10 trillion of just cash and liquid assets, wherein the entire bottom 60% just hold about 2.7 trillion. So this cash is much more likely to get invested than this cash down here. And you can see here the USA total wealth share. So top 0.1% of households versus the entire bottom 90%. And you can see that one holds about upper 20%, and this one holds about 20% of the total wealth in the system. So periods of inflation, the inflationary decades of the 40s and the 70s actually had, this is something important to understand, they actually had a decreasing amount of the 0.1% total value or hold of wealth in the economy, where the bottom 90% share of the economy was increasing, because they're much more likely to spend that money than the top 0.1%. And that's been important in CPI inflation in the past. And you can look at this Fed research to illustrate that point even more. So in 2020, when the Fed was injecting that massive amount of money, initially at least, the top 1% saw their cash assets rise as much as the entire bottom 80%. You can see the total amount of money that came in, that $2 trillion there, almost 1.5 at the top, and the rest got about 700 billion. So why is it important? Based on the Boston Fed, the bottom 20% of households are going to spend 97 cents of every dollar earned, where the top 20 are going to spend about 48 cents. So where that money ends up has a very important implication to whether or not it's going to trigger CPI inflation, or is it going to trigger asset price inflation. So this could explain potentially the lack of correlation in recent years between just the broad money supply and CPI. So we all know the Fed has been engaging in QE programs. We know that the total amount of broad money has been increasing in a fairly consistent manner since the financial crisis, or even a little bit before. But at the same time, unlike the past, we've seen CPI very stable on a relative basis, even though the monetary amount is drastically increasing. So that is probably potential reasons why that is in fact the case. But the question is that changing? So to understand that and to illustrate that point, we have to realize, like, are the bottom, so to figure out, is this really changing? We shouldn't just be looking at, hey, is there just more money in circulation? The question we should be asking is the bottom 90% having more access to that money and are getting more of that money because they're more likely to spend that? And if they're more likely to spend that, that's going to trigger CPI inflation. That's the question we should ask. So we are seeing now that almost 30% of income in the entire country is actually coming from government transfers. So the government has been funding the 90% far more than they have been funding them in the past. So you can think of it as the QE programs are kind of funding the top 10%, and the bottom 90% are getting money from fiscal policy.
Itai, is there any type of inverse correlation between CPI and asset inflation?
Yeah, so that's important to research. I think it's too new to run that data series, because obviously this is obviously my theory, but I think inevitably we should be able to observe that if that was to be true.
Okay.
So to answer that question, you know, this is credit card research from Bank of America, asking households that received stimulus payments, are you going to spend more? So 1-year rate of change includes the COVID base case effect. 2-year rate of change does not. So we should be looking at the 2-year rate of change to figure out, you know, people that have gotten stimulus, are they going to spend it? And you can see that households that receive stimulus are going to spend way more than 2 years ago, even at pre-COVID levels. Households that didn't get stimulus, so obviously people that are wealthy enough to be over the threshold of where they get the stimulus, they effectively don't intend to spend any more. So that is another, you know, piece of logic that I see to make sense of that.
Could that also be because the wealthy households, stimulus payments don't really do much to impact their lifestyle?
Yeah, that's exactly my point. So like when they have access to more money, they invest it, they don't spend it. But people that don't, they just spend it. But to make things different this time, this is probably why we're seeing a lot more money in the hands of the 90% in a way. So here you can see the COVID effect on GDP. This is based on a think tank research. So you know, aid to financially vulnerable households making a significant impact potentially on GDP. So that's a lot of it is going to people that in the QE programs and all that time they didn't have access to money before. So that is making a more significant impact on GDP and the economy as before. So then the question to be answered, then, you know, it's really an important thing to kind of realize, because you can basically map these inflationary regimes based on you know, where inflation is. So we call this period of disinflation, we called it Goldilocks, because asset prices, stock market, real estate tend to have performed really well during that time. And that time has really been, it started in 1983 when we went from a high interest rate period, interest rates started to slowly decline, asset prices started to stabilize. Very different than periods of high inflation, reflation, or before the periods of deflation that we're no longer seeing, with the exception of 08, which was a very small period of deflation in this big historic time frame. And we have to realize too, at the same time, velocity of money has stayed very consistent, very, very low. And in the past, the classic theory of inflation says that you have to have a monetary base increase, but you also have to have velocity of money increase. So you need to have, you know, if you think of velocity of money, you know, you go to a restaurant, you spend $100, the owner of the restaurant gets a portion of that. Let's say they get $70 off of that after they pay expenses, and then they go and spend it. And then that same $100 circulates and circulates and circulates. So typically it's difficult, it has been difficult to see a lot of inflation when velocity of money is very low. But we have to realize that there's just been such a large increase in the amount of money in circulation that it may be skewing those numbers of velocity. Because if we have 30% more money out there, that money is circulating a little bit less. So that's definitely something important to note. And the inflationary question is a very important one because of the performance of different asset classes during different inflationary regimes. So different assets have performed wildly different during different periods of inflation. Where you can see between high inflation, only gold historically has performed well. Obviously, we don't have cryptocurrencies in there because they didn't exist in 1928. Reflation, you know, we've seen equities perform relatively well. Disinflation, or basically we call it the Goldilocks. Actually, gold hasn't performed the best, but we've seen almost everything else does. And deflation pretty much hurts everything. So
So based on the environment that we're in right now, which of the asset classes are most intriguing to you as kind of a hedge to think about as we're going forward in time?
Yeah, so I still think that, you know, we are probably in this Goldilocks period for now until we have more evidence that it's not. But nonetheless, given the you know, historically, real estate has done well in periods of inflation and non-inflation. Gold is always a good hedge to hold. But I think for those that are a little bit more derivative focused and like to price different things. Given the fact that the interest rate market has historically failed to predict true inflation and where it's going, and given the dislocation between CPI and 10-year Treasury, potentially cheap, completely out of the money trades on bond futures or on bond options could be a really interesting thing to do in case inflation does come and spike out of control. More than this, this is definitely like a long-term way of looking at things. So I'll stop right there. I know that was a lot of stuff, almost exactly on the hour mark.
Cool. Yeah. What questions are there from the audience?
You talked about gold, Itai. What about silver or platinum or palladium?
Yeah, they're all correlated in the metal complex. Well, they're a little bit different, right? Because silver is an industrial metal. So silver has some correlation to the economy too. If the economy is really hot and there's a lot of demand, silver is going to do better than just, during a recession. Platinum and palladium's they're more industrial metals too. So gold has been more classic, just inflation hedge versus other uses.
So I think there is an argument that inflation is transitory. Now, for example, wages are rising like crazy. Wages usually don't go down. Let's say next year, lumber prices may go down because you can produce more, and shortages you can cover up for the shortage. And same thing you could do it for semiconductor and other things. So how long the prices have to stay high before, let's say if they still high for too long, 1 year, 2 year, then they become normal price, and then inflation is not transitory. Then that's basically permanent. So that's where my question is: is it really transitory, or just that? Probably not, because few examples if you take, they won't go down.
Yeah, you're right. Wages do tend to be sticky, but the reality is, how. I think it needs to stick for a few months at least for it to kind of become the new normal. I think it will be really interesting to see specifically about wages in the labor market. Once the unemployment benefits drop off, given the amount of open jobs out there, what's going to happen? And that's fairly soon. So I think in the next probably 3 months, we'll figure out whether or not inflation is in fact transitory or not. 3 to 6 months. So it's going to be an interesting time because the potential repercussions of what's going to happen given the inflationary regimes are pretty high.
I got a question here. What are your thoughts on farmland?
Farmland's a great inflation hedge historically. It's been non-correlated. It's kept up with inflation, particularly because if you get real CPI inflation, then food is a big part of it. Food inflation is gonna increase, so that's gonna increase the profitability. That's gonna keep up with the cost of everything. So it's been a good inflation hedge and overall a good long-term investment, as long as it could be managed correctly and a low leverage situation and a lot of different caveats like that, obviously.
Yeah. And as more building happens too, it's not like there's more land just popping up for it,
Sure, and there's also potential climate change impacts long-term, desertification, basically becoming more desert. Complicated word.
Definitely. One of the other questions was, what would ever push us to a deflationary environment?
Yeah, so what could push us to a deflationary environment is the hangover of inflation. So let's say inflation comes up too quickly. We've pretty much become reliant on a significant amount of Fed aid and money printing and low interest rates. If the Fed essentially tapers QE very quickly, if interest rates rise too fast, and lending condition becomes problematic, and as you well know, everything is based on debt. You can't pay for an apartment complex if you don't get a good loan at a good rate, then that essentially has the ability to hit asset prices really, really hard.
And I saw Ernesto had a question as well. Do you want to, Ernesto, if you're there, do you want to ask it? Okay, he may not be there. So how does the VIX behave in a high inflationary environment? Or is there any inflation?
Yeah, so the last high inflationary environment was like the real high level inflation environment was in the 1980s, and the interest rates started dropping in 1982. So the VIX wasn't formed back then. The VIX was formed in the 90s, and there's effectively, it's difficult to predict. There's no real history of the VIX in the 60s and 70s, where option trading just got really started with the Black-Scholes model in the 70s and things like that. So there's no real history to know what that would have been.
What other questions are there out there? Well, I had one right here asking about U.S. farmland and global warming. Is the wheat basket migrating to Canada and or Russian Siberia? I know that there's a lot in Ukraine, right? Ukraine's one of the biggest bread baskets.
It is. I read an article actually saying that in some cases, some crops, the yield may even increase in some areas dramatically because of the warmer temperature benefits different types of crops. So any certain amount of increase in temperature could potentially increase yields in the Midwest by even 10-15% and make some parts of Canada better for growing crops. So potentially global warming could increase yields in some types of crops.
I have some related question, maybe, to the, it is related to inflation. Now that if you see Fed's balance sheet, that has gone up, I think in 2007-8, before the crisis, so total debt was 7 trillion. We're close to 30 trillion now. Already, and then there is more, announcement that they're going to spend 3-4 trillion or 6 trillion up to more on the infrastructure.
Right.
US is a global reserve currency as of now. Russia has just announced that they're not going to keep US dollar in their reserves, so they'll remove it. China plans to do similar thing, and obviously there are some other countries that are also planning to do that. On the top of that, Bitcoin is coming up, and a lot of US controls a lot of foreign transactions because it goes through SWIFT. But if you have Bitcoin, then that kind of allows them to transact without US dollars.
So Sanjeev, if you don't mind me asking, what's the key question that you want to ask?
Okay, so my question is this: if US is not a global currency, how would how far this could go off inflation? Could it go out of control? Basically, that's where I was going to.
Yeah, that's obviously a big risk. So by the way, if you're interested, we did a very extensive 3-series on the petrodollar, and the US is the global reserve currency. We touch about a lot of those issues you brought up, including SWIFT and things like that. So you should check it out if that's of interest. Yeah, I mean, that's probably one of the more significant risks out there if there will be a loss of the dollar as a global reserve system, because a lot of the demand for dollars is in fact ex-US, as you well know, and that creates this consistent need for dollars. I don't particularly think that can happen overnight. I think this is more of a multi-year process, but nonetheless, it's definitely a threat, and I think it's wise of US leaders to effectively not abuse the dollar system, given that China and Russia are migrating away from that.
Great, cool. Well, Itai, I know we kept everybody at an hour, so we're gonna let everybody go from there. We appreciate you all showing up today, and obviously, if you have any other questions, you can always ping us directly.
I'm gonna give you one bonus chart. So in the 1990s, they changed the way CPI is calculated, and they also did that in the 1980s. substituted some of the format that they were using for CPI to account for it differently. The Bureau of Labor Statistics did it. So there's a cool website that calculates it the way it was calculated in 1990 and in 1980. So if you're interested to see what CPI actually looks like based on the 1990 basket or the 1980 basket, it's wildly different. So just wanted to leave you with that.
Perfect. Well, thank you for sending that. Everybody, we appreciate you coming on. Thanks so much. Obviously, feel free to come visit us at equi.com. And I also sent you the link to Shadow Stats. So we appreciate it. I'm going to stop the recording and we'll make sure to email this your way tomorrow. Thank you all.